Hey everyone, this is Dominic Weber with K&D Financial, and today I'm going to show you how I turned $6,000 into $16,000 in under 30 days. There is a ton of information in this, and we can't possibly cover everything, but we're going to try. Just a quick note, you can lose a lot of money trading. This is for educational purposes only. If you don't know what you're doing and you're not ready to lose the money, you should not be jumping into it. But it's also why we follow an algorithm, because it gives us the statistics and the probabilities to know exactly how much money we're going to make on every single trade. So first of all, how did I do it? I did it with heating oil contracts. Now I just wanted to show this picture up here because it shows you that heating oil is roughly 60% crude oil. So that also kind of helps us understand how we can use the crude oil charts to understand what's going on in heating oil. So first off, where's the proof? Well, you can see here, this is my actual statement in TradeStation. And you can see that down here I'm showing heating oil contracts. I'm showing the P&L, and you'll notice the first trade I did, I actually lost $453. It was I got stopped out, and if it's a positive P&L, you'll see it on the right. So here we are on the second day right here, and you'll see on 7-Eleven I entered with one heating oil contract, did not get out. Nothing really happened too much during this time frame. And then here you'll see that I actually had a profit of $1,300 on my heating oil. That's where I actually got stopped out. But if you'll notice the two over on the other side here, we actually got right back in and then proceeded to ride that all the way until we had a $6,921 profit on those two contracts, at which point I had to roll them. So that's why you see another two right here. And then finally, ending the month with closing out one of them at 2,100, carrying the other one over for 2,500, which I have since closed for about a $2,000 profit. So heating oil contracts take up $3,000 a piece. So I had two of those contracts, that's $6,000. I lost 500, made 13, made 69, made 21, made 2,000 for a grand total of 11,800 in profit. So I actually did more than 6 to 16,000, but it just doesn't ring off the tongue to say 17,800. So I kept it at 16. So the rules, how did I go about doing this? All you have to know is this is the major thing that we do with K&D Financial, and every single strategy that we're putting out is we're buying pullbacks in a bull market. That is what our S&P swing trader system does. It's the same thing here. It's just applied differently with a different kind of set of what we're defining as a bull market and what we're defining as a pullback. So let's take a look at the charts. Okay, so you can see here we started on 7.6, like we said, buy, sell, got stopped out. That's that $500 loss, then bought again, rode it all the way up to 13. At which point I got stopped out, but then I immediately got back in. In fact, I got in double where I bought another contract. So now I have two contracts, and then I'm rolling the two contracts here, and this is what this buy and sell is, and that's finally closing out. So what does that look like? Well, here you can see heating oil, and what we're talking about is you can see this trend line that was forming, and what I did is it came up and I bought in a pullback in a bull market right here. I bought here, and then it rode back up. Actually, this is where I got stopped out, and then I added two contracts and I rolled it up here. You can see that on this HOQ chart where I actually got in right here and I expected it to keep going higher, and it did not. So I was immediately stopped out, which is fine. I let it pull back. So what are we defining as a pullback? Well, it's pretty simple. Right below it, I have here the %R sitting on a 4-day, and we're looking for it to come back into the oversold region, and that would be our pullback. Sure enough, if we waited till right here, which I was a little impatient, bought, would have been fine, rode it all the way up. Right back here, I did it right, and this time, bought here and rode it all the way out. And so you can see as well, here's the second half of that where I rode it all the way up to here, got out here, and we've since pulled back a little bit. On top of that, the reason I know that we could do all this is, how did I know to define a bull market? Well, we've talked about this before, but the COT is a major influence. You can see that the commercials here, starting in 2017, started buying, and accumulating a position. So they're accumulating, going along and along. That tells me a bull market's coming. Whereas you can see the larges and the speculators are shedding positions. Furthermore, we have this huge trend line coming down, and another one which we broke during that time. And we have this other trend line where we made a long-term higher low than back here. And so that's another indication that we were on the right path. Next thing you can see here is this is the net positions on the COT, and I've marked off every single time this green dashed line. You can see the commercials went positive and the speculators went negative. We had a big run up. So it happened here, happened here, happened here. You did it here, you would have been wrong and it would have lost a lot of money. It happened here though, same thing. Did it here, you would have been wrong. Right here, again, right. So you can see here as well, why would you do that? That, you know, we can see that the speculators have been getting out. They're just super going bearish on this market. That's all indications that it's about to pop. Also, we have, if you look at here, the Williams ProGo, you can see that it's actually been trending up and making higher lows, and price was going down. Indications, again, of a divergence that we're going to pop to the upside. I know this chart's hard to see, but if we look at as well as principal, open interest and volume and on-balance volume, you can see once again that while price here is going downward, they actually started going upward. So right here to here and right here to here on this light green chart, you can see that price actually went down to down. So that's a divergence. That's another indication. Finally, we also have the stochastic here, if you want to take a look at it. We had a turn up right before July, telling me that, you know, something's on the way. And lastly, you could have just followed the 13-day moving average, comes up, pulls back to the 13-day moving average, and actually 13-day moving average, and then takes off to the upside. So these are all different ways that we indicated that we were in a bull market. We pulled back, we bought, and it was that simple. I hope you enjoyed this, and there's actually a lot more to come. If you'll notice right now, you can do this with a lot of different markets. I'm currently in bond market. What's happening in the bond market? Well, it's come up, it's pulled back down. You can see the standard deviation that we're in a bull market. It's come up, it's pulled back down, buying right here, and then going through. Same with gold. Gold's in the same exact thing right now. Big bull market, pull back, get in, come back up, pull back right now, touch this big trend line coming down, and it's heading back to the upside. So works over and over and over again. It's exactly what our strategy does at K&D Financial, and the difference is when you have an algorithm, the numbers are absolutely precise, rock solid, and we can test it. Same principles, everything works the same. It's just a lot more sure on the algorithm than this particular setup right here. So I hope you enjoyed it all, and we'll see you in the future. Bye.